Introduction. The role of personal financial statements. Navigating the financial landscape. Personal financial statements are among the most fundamental tools to use in helping people achieve their financial goals. Financial statements are the maps, if you will, that help people arrive at their desired financial destination. Personal financial statements comprise three basic personal financial tools: the balance sheet, statement of financial position, the cash flow statement, statement of cash in and cash out, and the budget. In many ways, financial management, that is, cash flow management, forms the foundational financial advice activity. Helping the client reach life goals is the overall objective of any financial engagement with a client. For the financial professional, personal financial management is perhaps the primary advisory tool. Until the financial professional develops and implements a sound financial management strategy, he or she cannot effectively address the client's financial goals and objectives. The initial focus of the financial management strategy is building a safety net, so if events happen that cause an interruption of income, the individual's financial situation will be cushioned from the shock it might otherwise experience. Once this safety net is established, the individual can begin to address other cash flow management areas, which include spending and saving habits, sources of income and whether any discretionary income exists, and if not, whether it should be developed, etc. The organized approach to financial advice. Navigating the financial planning process. Providing financial advice is not a haphazard activity. While financial professionals certainly can face situations that require immediacy, most of the time an organized progression towards a personal financial management process is preferable. Doing this helps the financial professional ensure he or she is addressing all relevant issues in an appropriate manner. The personal financial management process works best when the financial professional and client follow an organized series of steps. These steps do not require rigid adherence. Instead, they serve as guideposts to steer the process from the starting point to the destination. The steps are consistent throughout the professional financial planning process, changing only as the focus shifts to different aspects of the client's financial life. For example, investments, insurance, retirement, etc. We can define the steps of the financial planning process as follows. Establishing and defining the client-advisor relationship. Gathering client data, including goals. Analyzing and evaluating the client's financial status. Developing and presenting recommendations and alternatives. Implementing the recommendations. Reviewing and monitoring progress toward goal achievement. FPSB's financial planning process consists of 6 steps that financial planning professionals use to consider all aspects of the client's financial situation when formulating financial planning strategies and making recommendations. Number 1. Establish and define the relationship with the client. Number 2. Collect the client's information. Number 3. Analyze and assess the client's financial status. Number 4. Develop the financial planning recommendations and present them to the client. Number 5. Implement the client's financial planning recommendations. Number 6. Review the client's situation. Essentials of client data gathering in financial management. Gathering client data and general information are some of the main items required when approaching financial management. To this, we can add identifying and quantifying goals. The focus of any financial management strategy will be on helping the client achieve goals. It will be helpful for the financial professional and client to have a shared understanding of the client's current financial situation, especially of any areas that seem to be causing problems. These financial hotspots should be among the first areas to tackle in any interaction. It may be that the rest of the process will have to wait while the financial professional and client work through addressing bigger problem areas. As a financial professional, you should try not to enter a new relationship with many, if any, preconceived ideas about what the client wants and how to address stated and unstated concerns. Of course, a competent financial professional will recognize typical areas to be addressed along with recommended steps to achieve success. However, each client is different, and the exact process to address that client's situation will require some level of flexibility and customization. We will explore goals and the other steps as we progress through this course. First, though the financial professional must gather the information required to work with the client. In addition to fulfilling any legal and regulatory requirements related to advisory contracts, the financial professional needs to have enough information available to develop a workable strategy. Many financial professionals use structured data survey or gathering forms, and these can be valuable. In a previous course, the discovery process was covered in some detail and may be worth revisiting as a refresher. The financial professional should gather information that is both quantitative and qualitative. Qualitative data deals with goals, risk profile. Anticipated lifestyle changes include those pertinent to income and expenditures. Quantitative data includes things such as assets and liabilities, cash flows, insurance policies, current investments, retirement and other government or employer-sponsored benefits, and tax information. FBSB categorize the financial planning knowledge framework into: Number 1. Financial planning principles, process and skills. Number 2. Financial management. Number 3. Tax principles and optimization. Number 4. Investment planning or asset management. Number 5. Risk management and insurance planning. Number 6. Retirement planning. Number 7. Estate planning and wealth transfer. Number 8. Integrated financial planning. Unveiling client's financial status. Most financial professionals use the same fundamental information to determine a client's financial position. When providing financial advice, you will use financial statements and related information to identify a client's existing or potential financial problems. This will help you determine a client's financial needs, along with potential resource for addressing those needs. Comparing statements covering different time periods can help determine a client's progress toward meeting his or her goals. We tell clients to live within your means. That advice sounds good, and it seems to make sense. What exactly does it mean, and how do you know whether a client is doing it? A financial professional can get an idea about a client's financial status during the discovery phase of the relationship. However, many people either do not know the degree to which they are financially sound, or they do know and are embarrassed to tell the financial professional the truth. The best way to determine the degree to which clients are or are not living within their financial means is to compile and evaluate updated information about their assets, liabilities, and cash flow. Following is a brief review of some tools to evaluate a client's financial status. Unveiling the balance sheet. It is helpful for a financial professional to have a reasonably complete picture of the client's financial assets and liabilities. Analyzing a statement of financial position also known as a balance sheet, is a good way to gain this information. A statement of financial position is essentially a picture of the client's finances at a specific point in time. Information within the financial statement can change substantially year by year. Reviewing the statements helps the financial professional and client determine how well the client is on the path to achieving financial objectives. Over time, the statement of financial position will identify whether a client's net worth remains the same, increases, or decreases. The following equation shows the relationship between net worth, liabilities, and assets. Net worth is equal to assets minus liabilities. Assets. There are three broad categories of assets: liquid assets, cash or cash equivalents, invested assets, and use assets. Assets can be positioned within categories based in part on how the individual intends to use the asset. As an example, a person who has little, if any, desire to sell an antique vase would likely need to classify the vase as a use asset. If the person acquired the vase with the goal of selling it after a predetermined amount of price appreciation, the vase would be classified as an invested asset. Same asset, different application, different classification. Because houses, cars, or investments, such as stocks and bonds, are considered assets, they are included on a balance sheet. However, as identified above, not all assets are created equal. The liability. The liability side of the balance sheet lists current debts. Items in this category might include any outstanding balances on a mortgage note, auto note, or credit card statement. Liabilities often are categorized as either short-term or long-term, lasting longer than 1 year. A balance sheet lists the outstanding balance for each liability as of the date of the statement. Any overdue amounts plus additional interest and penalties should also be included. The liability entries list the debt amount, not the debt service amount. The mortgage balance is listed, but not the monthly mortgage payments. Those are identified on a cash flow statement. Equity. Stocks, often referred to as shares, are not just pieces of paper. They represent part ownership in a corporation. When you buy a stock, you are buying a slice of the company's assets and earnings. You become one of the business owners, known as a shareholder, and you are entitled to your share of the company's profits. These profits can come to you in the form of dividends or as an increase in the stock's value over time. But what drives the value of stocks? It's the company's performance, market conditions, and investor sentiment. A well-performing company with solid fundamentals can see its stock price soar, while the opposite can lead to a decline. Investing in stocks is a way to grow your wealth, but it comes with risks. The stock market can be volatile, and prices can fluctuate wildly based on a myriad of factors. Types of stocks. In the stock market, not all shares are created equal. There are mainly two types of stocks: common and preferred. Common stock is what most people think of when they talk about stocks. It gives shareholders the right to vote at shareholder meetings and to receive dividends. Preferred stock, on the other hand, usually doesn't provide voting rights, but shareholders have a higher claim on assets and earnings. This means they get dividends before common shareholders and have a priority in case the company goes bankrupt. Preferred stock can be thought of as a hybrid between a stock and a bond. The dividends are typically fixed and paid out regularly, making it similar to the interest payment from a bond. This can make preferred stocks appealing to investors looking for a steady income stream with a higher level of security than common stocks. Conducting client research. Clients do not always make necessary information available at the beginning of a relationship. As a result, financial professionals often must do some research to find the information needed for personal financial statements. Here are some places to explore. Asset or liability can be found in cash or cash equivalent, bank records, checkbooks, statements, tax records. Various investments, investment portfolio statements, real estate sales records, tax records. Vested pension benefits, pension annual statements. Homes, mortgage statements, tax records, real estate records, public real estate valuation records. Cars, boats, and other similar assets. Online valuation tools, banks, credit company statements. Other use assets. Professional appraisers, insurance agencies, auction houses, retail or wholesale outlets. Credit accounts and other loans. Current and past statements, bank records. Mortgages, banks and other lending agencies. Questions. Number 1. What is one of the common financial management dangers? Number 2. What is important about the timing of when an individual takes on a financial liability?